For this video, I wanted to discuss how the sale of U.S. corporate stock, so that's C corporation stock, is not subject to capital gains taxes if it's being sold by a non-resident taxpayer of the United States, right? So if you're a U.S. person and you're watching this, generally if you do sell stock in a corporation, you are reporting it on your Form 1040, right? It goes on 8949, that's Schedule D. You compute the capital gain, you pay taxes. The rules are a little different for non-residents that hold shares in U.S. corporate stock. Generally, the sale of that stock is not going to be subject to any capital gains taxes in the United States. And so what we're going to go through is the rules and some examples and then some of the exceptions that would apply. So generally, the sale of corporate stock is treated as the sale of personal property. Okay, and that's very important because the sale of real property has completely different rules, so it's important to note that corporate stock is going to be treated as personal property for purposes of these tax rules. So personal property includes all tangible or all property, tangible and intangible, that's not real property. Okay, fairly straightforward. Now, under Section 865A, governing the general rules on sourcing income, income from the sale of personal property by a U.S. resident is going to be sourced to the U.S., while the sale of personal property by a non-resident is sourced outside the United States. So what does that mean, high level? It means that if you sell property, whether it's in the United States or not, it ultimately is going to be sourced to where you as the recipient are located, right? So if you are non-resident, right, so you're living outside the U.S., you're not a U.S. tax resident, and you sell corporate stock in the U.S., that's personal property, that is going to be foreign source income. Even though it might be a U.S. company, the sale of that corporate stock is going to be sourced to where you are a resident. And then in addition, just to cover, for some of the U.S. trade or business or ECI risks, in Treasury Reg 864-4C23, it provides that stock in a corporation, whether that's foreign or domestic, is not going to be treated as an asset used in or held for use in the conduct of a trade or business in the United States. And the reason I want to highlight that is because I get a little kind of uncertainty from some individuals that say, well, I understand that it's corporate stock, but if it's actually doing business in the U.S., does that change something? Right? So if it's a Delaware corporation that's operated exclusively from, let's say, Germany, right? They have no U.S. presence other than it's a Delaware company. Is that fact pattern different than if we have a Delaware corporation and you've got a Delaware office, Delaware employees, and the like? And the answer is no, right? It's still corporate stock. So if you sell the corporate stock, we're just looking at the residence of the shareholder that's selling the stock. And then under the personal property sourcing rules, it's going to be sourced to where that person is a tax resident. Now, let's look at two examples here, and then the exception, the real property holding corp exception, which I really need to highlight because that is a very big exception that a lot of people overlook. So we have John here. He's a citizen and tax resident in France. He opens a U.S. brokerage account, puts in 10 grand, and the following day he buys 9,000 worth of stock in Tesla. Now, over the next 2 months, his stock in Tesla goes up, and now it's worth 12. So John decides to sell it, and he's got a $3,000 capital gain, right? 9,000 basis, 12,000 proceeds, 3,000 capital gain. Under 865A, the sale of that stock as personal property is going to be sourced to where John is a tax resident, right? So the capital gains are not going to be subject to taxes in the U.S., nor is the sale going to be subject to any withholding taxes under the FDAP withholding rules. Now, for those of you familiar with FDAP, it's the 30% withholding tax that applies on certain types of U.S. source income, so interest, royalties, rents, dividend income. That's where the tax is going to be imposed. So in this example, let's say Tesla pays a dividend, and that's being paid to John, who's a non-resident. Under the FDAP rules, the dividend itself is subject to withholding tax. So he would pay some tax there. But just selling the stock for capital gain does not subject John to any U.S. withholding taxes, right? Capital gains are exempt. Okay, so if we look at example 2 here for a closely held company, the analysis is the same, right? So John, Frank, and Amy are citizens and residents of Australia. They form a Delaware corporation to conduct their consulting business. And they set up a Delaware entity because they want access to the U.S. markets, right? And that looks better than having an Australian entity. So they formed the entity on January 15th, 2016. They run it for a couple of years successfully, right? 5 years. And then in February 2021, they're going to sell the whole company to a private equity group in New York. The terms of the sale is a stock purchase agreement rather than an asset purchase. So stock purchase meaning that the private equity group has agreed to just buy the company's stock off these 3 shareholders, right? They're not just after the assets in the company. So John, Frank, and Amy sell 100% of their corporate stock to the PE company. The capital gains realized from the sale of the stock are not going to be subject to any U.S. income taxes, so long as John, Frank, and Amy remain non-residents for federal tax purposes, okay? Very, very important. So again, yeah, you can have a company, start it, build it up, sell it, and then you're not going to have to worry about any capital gains taxes as long as you're a non-resident. Now here's where one big exception comes in, the real property holding corp. So under U.S. federal tax rules, U.S. real estate is already deemed to be engaged in trade or business in the U.S., and it creates U.S. source ECI. And so it's for that reason that if a non-resident buys U.S. real estate, whether it's for personal use or business, if they sell it, they are subject to tax on the sale of that asset. So the FDAP withholding rules come into play here and basically subject the non-resident to withholding tax on the gross sale proceeds of the property. Okay. Now that's important because the rule applies if you have a corporate entity that primarily owns and invests in real property, right? So what taxpayers were trying to do in the past was get around FDAP by basically investing in those real property assets through Delaware corporate entities and then just sell the corporate entity and think they could walk away without paying any capital gains. Doesn't apply anymore, right? If you have a real property holding corporation and you sell the stock, you don't get this kind of treatment under 865A where you can just treat it as personal property and not have to pay any capital gains taxes. So that's one such exception that non-resident taxpayers need to be aware of. But generally speaking, for the most part, if you've got Delaware or any kind of C corporation stock, you can sell those shares for a capital gain and not have to pay any taxes on the disposition in the United States. Now, really, really important here is the last element. This applies to C corporation stocks, okay? The rules change significantly if we're talking about pass-through entities. So if you have an LLC that's a partnership or a limited partnership that's taxed as a partnership, now these rules don't really apply anymore. Well, they apply, but now you have a look through to see if there is any kind of U.S. Any assets that are being sold that are used in U.S. trade or business. You have ECI. In those cases, selling the LLC units might subject a non-resident to some type of tax on the disposition. So this fact pattern here really just applies to the sale of U.S. corporate stock. If you're selling a partnership interest or other types of pass-through entity units, you're going to have a little more work to do to analyze whether you're subject to any taxes. So I hope that was helpful. If you have any questions, please leave me a comment below, and I look forward to seeing you again on the next video. Thank you.